welcome to our webinar. We're going to talk today about types of IRA accounts and qualified savings accounts. My name is Larissa Greene, and I'm going to walk you through all the different types of accounts that Advanta can help you with and sort of the pros and cons of each account. I just want to let you know that I am going to take questions throughout the webinar, so please feel free to type any questions you have in the chat box or question box, and I will check them. I also uploaded the slides as a handout, so if you look in your navigation, usually on the right-hand side of your screen, you're going to see a box that says handouts, and it'll be loaded there for you as a PDF. As I mentioned, my name is Larissa. I'm with Advanta IRA, and I've been with Advanta since 2011. I started out doing some of the record keeping for accounts, and I transitioned over to business development and education probably about 10 years ago. So I've been doing education for Advanta a long time. And in my years, we have talked a lot about different IRA accounts. Sometimes people will ask me, which account is right for them. And because we don't provide any investment, tax, or legal advice, I can't advise you on the right type of account. So I thought it would be good to put together a webinar where I can educate you about all the different types of accounts, how all those accounts can work together so that you can make the best educated decision for yourself and for your business as to which type of account or accounts will work best for you. So again, keeping in mind that we don't provide tax, legal, or investment advice. But if you're not sure of where a question falls, please feel free to ask it anyway. And if I can't answer it, then I can always refer you to attorneys, CPAs, and tax advisors that can assist you that have helped our clients in the past. It's going to be really a lot of information on today's webinar. And so the point of the webinar is really to get information out to you, and it is being recorded. So you'll have the opportunity to review it. Again, make sure you download the handout. If you have any trouble downloading the handout, I'll provide my contact information again at the end, and you can reach out to me and I'll make sure to get you a copy of that. But any IRA or former employer plan qualifies to be self-directed. There are also a few savings accounts that we're going to talk about that Advanta can help you with. You choose the type of account that you want to open with Advanta. So if you come to me and say, what account should I have? Then typically I'm going to start with a series of questions asking you what type of account you have already existing out there. Are you transferring money from that account? Do you have an old employer plan, or what are you trying to accomplish? And then we'll talk about the different types of accounts, and ultimately that decision will be up to you. And another important point is that you can have several different types of accounts. They can work together and they can partner together. So you can make contributions to multiple types of accounts. And then for some of these accounts that we'll talk about where their contributions are a little bit smaller, they can always be partnered with your larger accounts in order to make up the portion of that you need for a deal. So first, I'm going to tell you a little bit about Advanta IRA, and I think that's important because we will talk a little bit about self-directing IRAs today. And when we talk about self-directed IRAs, we mean something very specific. And then we'll really get into the main part of our presentation today, where I'm going to talk about all the different types of accounts. And you can see on this agenda, we do have a lot to cover, so I'm going to do my best to cover everything in good detail. But again, it'll be really important if you're sort of learning about the types of accounts to try to make a decision that you either reach out to a tax advisor and find out what they would recommend, or give me a call and we can go over this information again. So Advanta has been in business for over 21 years, and we have $3 billion in assets under administration. And we say administration because we do the record keeping and IRS reporting for self-directed accounts that are holding private investments. We have two offices. We're in the Tampa Bay area, or more specifically Clearwater, Florida, and then we also have an office in Atlanta, Georgia. But we can actually help anyone anywhere that has an account that is either a US-based retirement account or a US-based savings plan. And we'll talk about those savings plans again in just a moment. But we provide personalized service. So what makes us stand out from our competitors is very specifically that you get an account manager for your accounts, for your family's accounts, someone that will be familiar with the investments that you're making, somebody that you can reach out to directly and ask questions of. So it's a really great system. We've had it in place as long as I can remember. And this way you have the opportunity to get to know the person that is assisting you at Advanta, which I think is really great. We have events going on all the time. We usually have 2 webinars a week. They're normally Tuesdays and Thursdays. We also have a monthly virtual networking event that you are welcome to join. You do not have to be an Advanta client in order to join our webinars or our networking events. So I would encourage you to go to advantaira.com/events. We also have a podcast, and we post those podcast episodes wherever you can find podcasts, as well as to our YouTube channel. And we write blog articles so that we are kind of covering any relevant information to the IRA industry so that you can stay up to date and well educated. So I mentioned at the beginning that we handle self-directed IRAs, and our definition is very specific. And so when you talk about a brokerage firm self-directed account, you're talking about the ability to choose the number of investments, the different types of investments, and how much you'll invest in for each. But they're kind of selling you those investments. So they're all going to be market-based. They'll hold certain types of investments, stocks, bonds, and mutual funds, and then they'll give you a list and you can choose from that list. But our definition of a self-directed IRA is much different. We hold the account, you find the investment, and we help you get it in the name of the retirement account so that it's all done properly for record keeping and IRS purposes, but we actually don't sell you anything at all. And I see we had a few people join us late, so just as a reminder, if you have any questions, please feel free to type them into the question box. And as I go through the webinar, I'm going to make sure to get your questions answered. And I also did post the handout. So if you look in your right-hand navigation under handouts, you're going to see the PDF of the slide presentation. So that is going to give you the opportunity to save this information for review. I had something pop up that since nobody has audio, I'm showing on my end, my audio is clear. So if you can hear me okay, if you would just give me a it's okay or audio is okay, just so I know. But I think that the audio is coming through clearly. Audio is good. Okay. Thank you so much. Great. Perfect. Okay. I just want to make sure everybody could hear me. It would be a shame to go through the whole webinar and not have anybody hear the information. So again, a self-directed IRA is just the opportunity to choose investments outside of the market. We don't sell anything at all. We simply provide a service where we do the record keeping for those assets. And basically what we're going to do is first receive any cash. So your transfer, your rollover from an old employer plan or transfer from an existing IRA. And then we're going to help you make the investment you choose. And so you can see here, I wrote down several of the most common types of investments we see: real estate, mortgages, private placements, precious metals, and the list goes on. But today, instead of talking about this stuff and the rules for investing, we're going to talk about IRA account types. The reason, if you haven't heard of a self-directed IRA in the way that I am speaking of, the reason for that is probably just very simply because there's not a lot of administrators out there that handle these types of accounts. And so Advanta is unique in the fact that we are not a brokerage firm and we hold private investments. And there are a few of us out there, but just not as many as like the Fidelities, Charles Schwab's, Morgan Stanley's of the world. And only about 4% of retirement accounts are truly self-directed. So again, another reason you may not have heard of us. So the information I'm going to cover today is true about all IRAs, all savings accounts, all plans for businesses, with very few exceptions. There are a few exceptions as far as what plans are offering to you based on what the administrator will allow, but for the most part, these are going to be IRS guidelines for retirement accounts and savings accounts that I'm going to discuss. And so even if you're not ready to self-direct and you're just trying to figure out what type of account would be best for you, this information is going to be true. The types of investments that we hold, that's not specific to us, but we're specialized for those types of assets. But as far as the rules for contributions, types of accounts, who is eligible, all of that is going to be the same across the board because those are federal guidelines. Okay, so these are the accounts that we're going to talk about today simply because Advanta IRA offers them. We can hold traditional IRAs and Roths, inherited IRAs. We can also hold savings accounts that are health savings accounts and education savings accounts. And then we can also help you with plans for businesses or small businesses, basically solo 401ks, SEP IRAs, and simple IRAs. So these are all of the accounts we're going to cover today. So I wanted to start out with this plan contribution limit table for 2024, only because as we go through the different types of accounts, you're going to see that some have advantages as far as how much you can contribute on an annual basis over others. And so, but they're not all or nothing strategies. So just because you have a traditional or a Roth IRA, it doesn't mean you can't also have a SEP or a simple or solo 401k. That also doesn't mean you can't have an HSA or an ESA. And so when we talk about contribution limits, if you're really looking to maximize the way that you are saving tax deferred money, you can have many of these accounts as long as you're eligible. So here you can see that among the plans, the highest contribution limit is going to be $69,000. Or if you're over the age of 50, it's going to be $76,500. That is with the solo 401k. But again, you can have many of these accounts and contribute to many of them in the same tax year. And so we'll talk about that coming up here shortly. So I'm going to start with traditional IRAs. And I think traditional IRAs tend to be the one that most people are familiar with. Most people have either heard of a traditional IRA and they know it's tax deferred money, or they have an old employer plan that they've moved to a traditional IRA at some point. And so here is the criteria. Anyone with earned income is eligible to contribute. So if you have $2,000 in earned income this year or $2 million in earned income this year, you can contribute to a traditional IRA. But thinking back to that contribution table, remember that the contribution for 2024, the limit is $7,000 or $8,000 if you're over the age of 50. But you are also going to be limited if you had minimal earnings this year. So if you earned $2,000, then the most you could contribute for the year would be $2,000. So it's either your earnings or $7,000 or $8,000, the lesser of the two. So please keep that in mind. Typically, a traditional IRA is going to be deductible. We're going to talk about that in just a moment. So you put your money into a traditional IRA and you get a deduction on your taxes for doing so. And a lot of times people will rely on their traditional IRA contributions for deductions every year. So many people say, well, if I don't get a deduction, then I don't want to make a contribution. And we'll talk about that a little bit when we talk about Roth IRAs, because when we talk about Roth IRAs and we talk about how they're tax-free, you're going to see the difference between those two, but why somebody might choose one over the other. So the traditional IRA is going to be tax deferred. That means that when you put your money into this account, you're basically kicking the tax can down the road. You make a contribution, you get a deduction typically on your taxes, and then that growth is tax deferred. And then when you reach retirement age, you take distributions and pay taxes. The tax deduction is lowering your current tax bill. It's tax deferred growth. And a really cool thing about a traditional IRA is that former employers plans like 401ks, TSPs, 457 plans, if they are pre-tax, they can go into a traditional IRA without tax or penalty paid. Okay, so that's a really cool thing about a traditional IRA. So if you want to take control of that old employer plan, it's just sitting out there in left field and you're not sure what to do with it, you can roll it over to a traditional IRA and avoid taxes and penalties so that you can now make investments of your choosing. Now, I put emphasis on the facts that, most of the time you're going to get a deduction, but there are deductibility phase outs depending on your income and depending on your participation in an employer plan. So I included this table. There is really two tables to be concerned about if you or your spouse contribute to an employer plan. I only included this one because the IRS hasn't updated on their site the numbers for the other table. They still have 2020. I mean, it was weird. I think it was 2021 still connected to that link, and I couldn't confirm whether or not those were still the same, so I didn't want to include that. But just be aware, this table is if you are covered by a retirement plan at work, then you're going to have deductibility phase outs. You can still make your annual contribution to a traditional IRA. You can still get that money in there. How much you earn has nothing to do with it. You can still put that money in. But whether or not you get a deduction is going to depend on two things. One, if you participate in an employer plan, and two, how much money you earn. And you can see here on the table, I won't go through all of the numbers, but this is for your information. That it depends on how you file as well. Single head of household, married filing jointly, or married filing separate. I've included the rules, but I also included a link directly to the table so you can review it. This plan, or this table, again, covers if you are making contributions and you are covered by a retirement plan at work and it's dependent upon your income. If you're not covered by an employer plan, but your spouse is, there are different limits, and that's the one I couldn't confirm if they had changed for 2024 yet. I'm going to continue to look for that information. So if you need it, please feel free to email me and I'll get it over to you. So traditional IRA distributions, if you take money out before 59 and a half, that's a 10% early withdrawal penalty. Sometimes people call this a tax, but I'm going to specify and call it a penalty because the tax amount is not determined by a set rate. It's determined based on what your tax bracket is the year you take a distribution. So I'll give you an example in just a minute so that I can clarify. But if you take money out of this account before 59 and a half, there is automatically a 10% early withdrawal penalty. It's tax deferred after 59 and a half. And when you take distributions, they are taxed as ordinary income in the amount taken out the year of the distribution, and it's reported on tax form 1099. So let me give you an example. Once I reach age 59 and a half, I can now start taking penalty-free distributions. Let's say I take $10,000 in the year 2024. That means that that $10,000 is going to come to me. And because I'm over 59 and a half, I will not be subject to the 10% penalty, but I'll be subject to taxes as ordinary income. So I'm going to receive a 1099 for $10,000 for 2024 so that I can include it in my ordinary income when I file my taxes this year. You have the opportunity to withhold some of the taxes when you take a distribution in most cases. So this is going to be one of those things where it's specific to the plan and the plan administrator. But in most cases, you're going to be able to opt into having them withhold taxes for you. Okay. There are exceptions for the 10% penalty. So if you're trying to take a distribution before 59 and a half, if it's for higher educational expenses, disability, first-time home buyer, and inherited IRAs are not subject to that. But whether or not you fall under one of these categories for the exception, I would check with an accountant. The traditional IRA has a required minimum distribution that starts after the age of 73 if you have not yet reached this age. And I specified that because it was 72. It also was 70 and a half at one point. And so slowly we're kind of bringing that age a little bit higher. But just so you're aware, if you haven't reached age 73 yet, then it's going to be 73 for you. And at that time, the IRS requires that you take some money out. It's a percentage based on the total account value and your age. And the calculation is redone every year based on the December 31st value of the previous year. So that's the required minimum distribution. You can still always grow the account and you can still add to it as long as you have earned income. I had a question pop up. If you are retired and receive a pension, how is the limit determined for IRA contributions? That's a great question. I don't believe the pension is going to count towards earned income, and that's where we're really focusing on earned income, not passive income. It's going to determine how much you can contribute. But let's say, for example, you had a side hustle and you are earning $10,000 a year in that side hustle, and then you can contribute $7,000 or $8,000. I imagine if you're retired, you're over 15 and a half. In most cases, then you can contribute $8,000 again, as long as you have an earned income. So that is very important because a lot of times I talk to people with passive income and they say, well, I don't pay self-employment tax. I don't have ordinary income in that way. Well, then that is really going to limit the accounts you can contribute to. There's only one account that will allow you to contribute without actual earned income, and that's a health savings account. An education savings account as well, but a health savings account. And there are restrictions as to what age you can set up HSAs and your eligibility, and we'll talk about that in a little bit. So here I included just this quick table, and I feel like it could be a little deceiving here just because there's so many check marks in the Roth IRA side of the table that it makes it look like it's more of a benefit, but it is not necessarily. There are income restrictions. So the second line up from the bottom, the Roth IRA has income restrictions for whether or not you can even contribute. The traditional IRA, although it has deductibility limits, there's no income restriction for actually making your contribution. So as long as you have earned income, you're eligible to contribute to a traditional IRA. You also get your tax deduction. You have tax deferred growth. You can make contributions beyond 72 or 73, or what we call required minimum distribution age, as long as you have earned income. And flexibility with distributions also applies. So there is a lot of benefits to a traditional IRA, but of course there is some downsides to it too. You have to take a required minimum distribution when you reach 72 or 73. And for some people, they say, well, you know what, I don't need that IRA money. I wanted to leave it to my kids, for example. And some of you may not see that as a bad thing. You might be taking distributions to do as the IRS intended and living off that money when you reach retirement age. And so required minimum distributions mean nothing to you. There's a lot of pros and cons to each type of account, and that's really what I wanted to emphasize here. So now we'll move on to Roth IRAs, and Roth IRAs are great accounts, don't get me wrong, but I just want everybody to, understand that when somebody says, oh, you have to have a Roth IRA, it's tax-free, it might not always meet your goals, and that's what you should be aware of. Okay, so a Roth IRA, anyone with earned income that does not exceed the income limits is eligible to contribute. It is tax-free earnings with no taxation on withdrawals, but two things have to be true in order for that to work. One, you have to reach age 59 and a half, and you have to have had the account for a minimum of 5 years. And I don't mean this Roth account specifically, I mean, you have to have a Roth account in your name that you've contributed to for a minimum of 5 years anywhere. So as long as you have one Roth account, it could be, with any bank, with any brokerage firm, with any self-directed IRA company, as long as you've had it for a minimum of 5 years without closing it, and as long as you reach age 59 and a half, then your contributions and earnings are completely tax-free. And that's a lot of times why people lean towards a Roth. But again, you're not getting deductions for making contributions here. And so if ultimately your goal is to have deductions, that might not make sense for you. There are no mandatory withdrawals. So remember, we talked about 72 or 73 for required minimum distributions. Then you just want to keep in mind that the Roth IRA does not have required minimum distributions. And ultimately, the reason is probably simply because you've already paid taxes on that money, and the government is not going to receive any revenue from you taking distributions. And so they don't care if you take distributions. You might want a Roth if you're in a low tax situation this year and expect higher taxes in the future. So if you contribute now, and taxes inevitably will go up and you have a long time before you retire, you might look to making after-tax contributions so you can take tax-free distributions, 30, 40, 50 years from now. If you are not eligible to contribute to a Roth IRA directly because of your income, then you can always contribute to a traditional and then convert it to Roth, and that's called a backdoor Roth contribution. And we actually have a webinar on that as well. So if you're interested in learning that, I'm going to touch on Roth conversions, but just really quickly. So if you want to learn more about that, let me know. Again, send me an email and I'll make sure to get the webinar out to you. Okay, so here are the income limits for contributing to a Roth. And I feel like this comes up a lot because you might not know what your total earnings will be for the year until after January 1, and then we do have people reach back out to us and say, well, I accidentally made a contribution to a Roth, I had made too much money, how do I fix it? And they basically have to do what's called a recharacterization and make that money turn magically into traditional contributions so that they're following IRS rules. So you can see, again, there's the 3 categories: married filing jointly, single head of household, or married filing separate. We won't go through each of the amounts, but you can see them here on the screen. And then I included the link to the website for the IRS so you can take a look at it directly and read any comments that they have on that. But ultimately, if you earn too much, depending on how you file, then you may not be able to contribute directly to the Roth. But again, that's where maybe a backdoor Roth IRA comes in. So with Roth IRA distributions, you have a 10% early withdrawal penalty if you're under age 59 and a half. However, it does not apply to contributions. So if I put $7,000 into my Roth IRA this year, and then I find out, I needed it, let's say we're in Florida, there's been a lot of destruction from storm. If I said, oh my goodness, I need it to do home repairs or something like that, I can always distribute amounts contributed over any number of years with no tax and no penalty. Because I've already paid tax on it, the IRS gives you flexibility on taking distributions of contributions you've made. Now, you can't take earnings from any of those contributions because then they would be subject to early withdrawal penalties and taxes because you haven't met those two criteria: the account open for 5 years and 59 and a half. There are exceptions to the 10% penalty, just as we discussed before, for traditional IRAs. And a really cool thing about distributions from Roths is that when you take a distribution, they have ordering rules for Roth distributions that just happen automatically. When you take a distribution, it's first considered a part of contributions you've made. If you distribute more than contributions you've made over any number of years, then the next thing is going to be conversions. Anything you converted from a pre-tax or traditional account to a Roth account will be considered second in that ordering. And then the third would be earnings. So there's a really good chance that if you've made contributions over several years and you needed, money in an emergency to take a distribution, that you might not have tax or penalty, or maybe less than you anticipate because you can take your contributions out. So I think that's a really cool thing and unique to Roth IRAs. I included this table for you guys, again, just so you can look at it, again, comparing traditional and Roth IRAs. Remember, it's a little deceiving because Roth IRAs have more check marks, but really it's mostly because this line 1 from the bottom says income restrictions, and that does apply to Roth IRAs. But both of these accounts are great because they both have tax deferred growth. Roth happens to be tax-free as long as those two things are true. You have a lot of flexibility with making your contributions, meaning that you don't have to contribute to the limit every year. You can contribute just what makes sense for you. And you can take distributions at any time, but just remember that they're subject to tax and penalty depending on eligibility. Now we're going to go on to Roth conversions just very, very quickly, because I mentioned it and I like to cover it because we're approaching the deadline for Roth conversions. If you're thinking about converting money to Roth, just know it has to be done by December 31st. It's not something that you can do into the next tax year and credit to the previous tax year. It's considered part of the calendar year that you do the Roth conversion in. So it maximizes non-deductible traditional IRA contributions. So if you aren't getting a deduction for making your traditional IRA contribution, then you could immediately convert it to Roth so that that non-deductible or basically tax-free contribution grows tax-free as well. If it stays in the traditional IRA, then it's going to grow tax-deferred. Anybody, regardless of income limits, can convert money. So if I have $100,000 in my traditional IRA and I want to convert it to Roth, but I'm worried about the tax bill, I can also convert over time, and it does not have anything to do with my earnings. You can use a traditional IRA conversion to contribute to the Roth IRA, and you could pay less in tax now rather than later, meaning that if you have an investment coming up and you know it's going to be a windfall and you want to basically minimize tax that you'll pay at retirement because of this great investment you have coming up, then you can always convert the funds into a Roth IRA and then make that investment through your Roth IRA in order to avoid taxes down the road on that investment. Many people convert because they have a lower tax situation this year, so they can offset the taxes that will be paid, or depending on when you're going to retire, if you have years before retirement, you might say, hey, I anticipate taxes going up, and so I'd rather pay tax now. Remember, please, that the tax is paid by the IRA, or excuse me, the tax is not paid by the IRA account. A lot of people don't realize that we cannot withhold during a Roth conversion. All of the money is going to go over to the Roth. You're going to receive a 1099 for that conversion in the year you convert so that you can pay tax as ordinary income personally. So if I'm going to convert $10,000, like in my example, then I'm going to receive a 1099 for $10,000, and it's going to appear as if I brought another $10,000 into ordinary income this year, and I personally will be responsible for the tax bill. I had a question pop up. Can you convert a property in an IRA? Yes, you can. You can convert the property. You can convert it over time. And basically what you will pay tax on will be the the amount the property is worth. So you have to have an appraisal of that property done, and that certified appraisal is going to determine what the 1099 will be. And so if, let's say, your property appraises for $300,000 and you decide to convert 50% of it, you're going to have a 1099 for $150,000. Even though it's an asset converted, it's going to appear as if you had an additional $150,000 in ordinary income. I had a question pop up. Do either of these options have checkbook control access? They can. Any of the accounts that we hold can have checkbook control. You would just ultimately be setting up either an LLC or a trust so that you can have checkbook control of that account. I do talk about that at the very end of the webinar, but only briefly. So if you want more information on that, I can certainly send you a webinar on how to gain checkbook control. Any retirement account or any savings account that we hold. It's just a little more detail than I want to go into right now because we have so much information to cover. I had a few more questions pop up. Just bear with me for a quick second. Can I only contribute, can I only convert funds I contributed in a given year? No, you can convert any amount you want. So if you have $1 million in a pre-tax IRA and you want to convert that, just keeping in mind that it is going to be a tax bill to you. And so if this is the year, let's say your account says, hey, we have a lot of losses we can account for, this is the year for you to do the Roth conversion, then you certainly can do that. We're going to take your direction, but it's not based on your contribution. That's just an idea that we see people use for converting contributions that are not deductible in a traditional IRA. I had a few more questions. Hold on just a second. Okay, I had a question pop up if existing Roth IRAs can go into the SEP. You can make Roth contributions to a SEP IRA now because of Secure Act 2.0, and we can help you with that. However, they did not give us any, they meaning the IRS has not given us any clarity on doing a transfer of a Roth IRA into a SEP. And so currently we can't help you with that. We're waiting on clarity from the IRS for that. But right now there isn't a way to move a Roth IRA into a SEP. But you can certainly make Roth contributions for the SEP. Okay, let's go on and I'll, continue to get your questions in there and I'll answer them as I can. And I'm sorry, I'm struggling a little bit. I'm losing my voice. So we're going to talk a little bit about employer-based plans. SEPs and Simples are IRA accounts, so we're going to start with those, and then we'll talk also about the solo 401k. So there's 3 components to an employer-based plan. There's the sponsoring business, participants or employees basically, and then the contributions. And a lot of times when we say sponsoring business, people who are sole proprietors and don't have an entity established for their business are like, well, I guess I don't qualify, but that's not true. As a sole proprietor, you can be your own sponsoring business. You don't need to have a formally established entity in order to have an employer-based plan. So, don't lean too hard onto the sponsoring business because it can also be a sole proprietor. So this is the entity or person that basically sets up the plan and makes decisions as far as how the plan will be administrated. The participants or employees could also be you as a sole proprietor. So you get to wear both hats here, but if you do have a formally established entity, you know that a lot of this stuff is just paperwork and you're your own boss, you're your own employee, you are the business, and we understand that at Advanta. We work with a lot of small business owners. And then making contributions, and some plans will allow contributions voluntary, or there'll be mandatory contributions from the employer, or both. It just depends on the plan itself. So like I said, we'll talk about SEPs and Simples first because they're IRAs, and basically they're IRAs meaning that they're administered the same as like a Roth or a traditional, where we help you set up the plan, we do all the record keeping, and they're very easy to do record keeping for because they're IRAs. So you can have one if you're a sole proprietor, an independent contractor, you're self-employed, there are partners, corporations, or S corporations. Lots of self-employed individuals are going to be eligible for a SEP or a Simple. The SEPs and Simples offer tax-deferred growth, and SEPs can now offer Roth, which is after-tax growth as well. Simples should be quickly to follow. We're again just waiting on record-keeping guidelines for the IRS for those because they did allow it, starting with the Secure Act 2.0. But right now, Advanta is allowing SEP contributions to be considered Roth, so that's up to $69,000. And then I had another question about that. Can you move a SEP to an IRA? You absolutely can move a SEP to an IRA. That's not a problem because a SEP is an IRA just like any other. And so those two can be moved. And again, the pre-tax money in a SEP could go to a traditional IRA. If there's Roth money in the SEP, which is a completely new concept, would go to a Roth IRA. But then currently, you can only move traditional or pre-tax money back to a SEP. So just keep that in mind. And I know that doesn't make a whole lot of sense, but the 401k is the exact same way for whatever reason. You can make larger contributions and have lower administrative costs. Remember, we're going to do all the administration for you. And then we also are going to talk about a solo 401k where there is potentially the largest contribution for a business without employees. So what types of employees can be excluded? Individuals under the age of 21, non-resident aliens, and union employees. Typically, we're working with people who have no employees, but every once in a while, we are working with people who have employees, and so they're not eligible for a solo 401k. And maybe they just have a part-time employee that's new to the business and they don't want to have a retirement account for them. Then a SEP or a simple makes sense because they can be excluded for a certain period of time. What types of employees must be included in a solo 401k? Those who work at least 1,000 hours per year or 500 hours for 3 consecutive years. In a SEP, those who have worked at least 3 of the last 5 years. And in a simple, those who have received at least 5,000 in compensation during either of the last 2 years. Okay, and another question pop up. Okay, so if I'm employed and I have a traditional 401k, but I also have my own business as a partnership, can I have a SEP or a simple IRA? The answer is yes. Because you work for, so I'm just going to say, even though this isn't always true, but if you're a W-2 employee, for example, so like I'm a W-2 employee of Advanta, this is not my business, I work for Advanta, but I also have a side hustle, then even though I participate in Advanta's 401k plan, I can still have an employer plan for my business. These two businesses are separate, but the amount you're participating in your 401k at work might come into how to calculate your contributions for an employer when you have your own business, but probably not as much for a SEP or simple, but it would be a great question for an accountant to help you calculate that contribution. But so for example, if you had a 401k with your employer, but then you had your own 401k, your employee contribution of 23,000 is per person, not per company, but then your employer contribution is per business. And so you still could make contributions. You're just going to make sure you factor that in when you're looking at your calculations. So SEPs and simples have a lot of advantages. They're less expensive. Contributions are made to IRAs. There's no fiduciary liability for the owner of the plan. Individual employees choose the IRA custodian. And I think this is a big benefit because when you have a SEP or a simple and you have employees, if you want to self-direct your plan and they don't want to do that, they don't have to. They can set up their plan anywhere they want. You get the information from them so that you can help by making the business contributions or employer contributions to their plan for them, but you don't have to be involved in the type of account that they choose. There's flexible contributions and distribution features, and then employer contributions only to those employees with more than 2 years of service for a simple or 3 years of service for a SEP. So again, if you have employees brand new to the business and you want to wait to see if they make sense and they're a good fit for the company, you have the ability to exclude them for a period of time. We had a question pop up. Does Advanta offer SEPs and simples? We do. Absolutely. We can help you with that. So now I'm going to talk about solo 401ks, and I separate these out from SEPs and simples a lot of times just because they're sort of a different animal. They work differently. The idea behind them is the same. You're still saving for retirement, but the formula for making the contribution is a little bit different. So a SEP IRA is $69,000 for this year. A 401k is $69,000 for this year, but those numbers are arrived at differently. They are the SEP is 20 to 25% of your total income as the employer, and that's it, up to 69,000. So if you had 100,000 in earnings this year, then you could put 25,000 up to 25,000 into a SEP. Just depends on how your business is set up and how you pay yourself. With the solo 401k, that same 69,000 is first 23,000 of the employee contribution plus another 20 to 25%. in as the employer contribution. And so ultimately you could put, say, 48,000 into this plan. And then our plan has a third type of contribution that as long as you had it in earnings, you could potentially max it out putting 69,000 in. And so you could see where that really is potentially the largest contribution you can make among these three plans. So higher funding limits, you can defer a larger amount of your income and get a better deduction. So as long as you're eligible and you can get a deduction, you can do that as the employee and the employer. You have funding flexibility, rollover opportunities, meaning that if you have an old employer plan or an old pre-tax account of pretty much any kind, it can go into the 401k. You have access to tax-free loans. So if you've heard of a participant loan from a 401k, even a solo 401k can do that, and you can borrow 50,000 or 50%, the lesser of the two. And then it's also cost-effective for administration because this is a small plan for a small business. And so it's not terribly expensive, and because we don't handle anything with testing for employees, it's really a lot less than a more traditional plan, I should say. And then, of course, the ability to make Roth contributions to the 401k. I'm going to check and see. I think I have a few more questions here. Can I take a tax-free loan from a traditional IRA? You cannot. The IRS only allows loans currently from the solo 401k, or I should say 401k in general, as long as the plan permits it. So remember, I talked a little bit about how the plans are pretty much, the rules and guidelines are going to be the same, but some things are going to be plan specific. So the IRS says you can take a loan from the 401k, but then you also have to review your plan documents and make sure that your plan administrator or the plan document itself is allowing for loans from that plan. But an IRA is not something you can borrow from, only a 401k. So a 401k allows those loans to participants. I am getting a lot of questions with a lot of more personal details. So if I don't cover what you're asking, just make sure to reach out to me and we can go over that. Like I said, we have a lot of material I want to get through before the end of the webinar, but also, you know, some of it seems a little personal. So let's just make sure to connect after the webinar, and I'm happy to answer any of your questions. Okay, so now we're going to talk about health savings accounts. Again, this is an account that we have an entire webinar on because there's so many benefits and so many details to it. So I'm just going to glaze over it here in this webinar, give you an idea of how it works. We're coming up to open enrollment, so I think this is going to be important to a lot of people, and I know we have a webinar coming up where we're going to cover all of this in more detail with health savings accounts. My partner Alex talks about these. He's really sort of our resident expert for health savings accounts. And so I think if you are looking at a high deductible healthcare plan, it would be really important to join him for that webinar, or at least get the recording. I know it's coming up here shortly. I don't have the date off the top of my head, but it's also something we have previously recorded. So you can always go back through our archives on our YouTube channel and check it out. A health savings account is also known as an HSA. It's a special savings account just for health expenses. It's supplemental to health insurance coverage. It's portable, so you can, even if your employer is offering it as a perk and you leave the company, you can take it with you because it is not an employer-based plan. It is for individuals. Some companies do use it as a perk. Hey, we know our health coverage has a high deductible healthcare plan, but we will make contributions for you to an HSA to help offset that plan. Contributions are tax deductible. And this account is typically considered a triple tax advantage account because you put contributions in and get a deduction. You take money grows tax deferred, and you take out money for medical expenses that are qualified, and it's considered tax free. So there are a lot of benefits to this account, but you do have to qualify. This isn't a way to self-insure. You do have to have a plan that is going to, a healthcare plan that's going to allow you to make contributions to an HSA. HSAs supplement high deductible healthcare plans. If you haven't seen ADHP before, that's high deductible healthcare plan, and allow for payment of non-covered healthcare expenses with tax deductible money. And our website does have a list for you of those expenses, so you can check it out. Just go to types of accounts, click on HSA or health savings accounts, and you'll find the list there. And you are treated as having an HSA for the calendar year as long as the high deductible healthcare plan was in place by December 1st of that year. That's the first day of the last month rule. And so if you are getting ready to shop out your healthcare and you want to have an HSA, make sure that you choose a high deductible health plan that allows contributions to HSA. That's super important. It's not just HDHP, it has to allow those contributions. And then once your high deductible healthcare plan is set up, as long as it allows those contributions, you can make them all the way up until your tax filing deadline, which is April 15th. Okay, it's not your business tax filing, it's individual tax filing, which is April 15th. No extensions, so you can't make contributions after with extensions. It's only April 15th. To keep the full year's contribution in the HSA, you must maintain that high deductible plan for a full 12 months. Okay, so distributions you take tax-free anytime after expenses have occurred, meaning you don't have to take them when expenses occur. You can actually save up your receipts and take them at a later date or even years from now, as long as you have those receipts in case the IRS ever audits those distributions. They're going to be tax-free as long as they're for qualified medical expenses. And that's regardless of age or how long the plan has been in existence, as long as these requirements are met. Distribution is for qualified medical expenses and expenses occurred after the HSA has been established. So I'm going to check for questions on HSAs and then we'll move on to ESAs. And then I want to talk just a little bit about how these accounts can work together because, we're going to talk about ESAs and the contribution limit for that is only $2,000. And people say, well, if I open this plan, what can I do with that $2,000? And so, I want to talk about how these accounts can work together so that you can open those accounts with confidence and find investments that make sense for you and your family, but then also grow that money. So education savings accounts are great accounts. They're sometimes called Coverdell Education Savings Accounts, CSAs, ESAs. They go by many names. Contributions can be made and used for qualified educational expenses, including tuition, books, fees associated with qualified elementary, secondary, or higher education institutions. So it's really cool because it doesn't have the same limits as a 529 plan. And if you have a 529 plan for your kids or your dependents, you can still have an ESA. These accounts are not the same. 529 plans cannot be self-directed. But the ESA can, and so, it's a benefit. And another really cool thing about it is that you can change the beneficiary of the account if the money is not all used. So I will use myself as an example. If I said I have 3 children, if I set up an ESA for my oldest, and my oldest child does not use all of that money before the age of 30, I can transfer that money to the next child. If that child does not use all the money, then I can transfer it to the 3rd child. And if that child does not use all the money, then I can transfer again per the rules to other qualified family members. So it's very cool that you can change the beneficiary and really do make sure that there are some savings and some generational savings in an ESA for qualified education expenses. If all of the money doesn't get used, then it's going to be distributed at the age of 30. You do not need earned income to contribute to an ESA. Check with your tax professional, but they can help you understand what is required in order to make contributions to an ESA, but the contributions are very flexible. And then contributions to this college savings plan are discretionary and not required annually, meaning that if you put $1,000 in for your child, well, the limit is $2,000, but you do not have to contribute $2,000, and you might put $1,000 in for a specific investment, and you might never contribute to this account again, but you can continue to earn within the account as well, just as any of these accounts. Contributions can be made as late as the contributor's tax filing deadline. So not deadline plus extensions, just deadline, which is April 15th. So if we get into 2025, just like the HSA, you can still contribute up until April 15th for 2024. And here are the contribution limits again. So we kind of compared all of the accounts. Now you can see what these contribution limits are again, now that they maybe make more sense to you. I had a few more questions pop up, so I'm just going to check them out. Do you need to be employed to have an HSA? You don't need to be employed to have an HSA, but you do need to have a high deductible healthcare plan. That's the important part there. there are two types of HSA accounts. One's for an individual, and you have an individual healthcare plan, and one is for a family. So that would be with a plan that is for the family. So again, just making sure that if you have a high deductible healthcare plan, that you're checking to make sure that that plan allows contributions to an HSA. Can you have an HSA if you have Medicare? You cannot after you are receiving Medicare, because Medicare system doesn't allow contributions to an HSA. So again, looking at plans that allow contributions to an HSA. If you had an HSA in place before you qualified for Medicare, it can stay in place, but you're not going to be able to take those tax-free withdrawals for medical expenses anymore. So that's going to be, important. Now, if you had saved receipts and you didn't distributions before, again, you can take distributions at any time as long as they're qualified. I had a question about an HSA through an employer. I haven't made contributions in many years because I thought they were made through the employer. HSAs are individual accounts, and so you can move that plan, or wherever the employer was keeping that plan, those are individual accounts. So as long as you qualify, you can still make contributions to the HSA. Sometimes an HSA, that sort of acronym is used for health spending account too, which is different. So just make sure it's a health savings account. And the account itself is an individual account, so you should be able to move it. It's portable. You can move it to another provider of HSA accounts in order to make contributions, again, as long as you're eligible. If you have a high deductible healthcare plan and your plan allows contributions to an HSA, you can still continue to make contributions. Employers do that as an employee perk, but technically it's an individual plan. You can still make contributions to that account as long as you're eligible. That question keeps coming up again and again, just making sure you have a plan in place that allows contributions to an HSA. A question that popped up, does an HSA cover dental, eye, and hearing? That's a great question. I honestly don't know, but if you want to check out our website or send me an email and I'll connect you with Alex. Again, he's our sort of resident expert on HSAs, but the list is on our website. Okay, so contributions versus earnings. Contributions are based on the limits, the table I just showed you, but your earnings are unlimited. So even though, for example, you can only put $2,000 into an ESA every year, your earnings are unlimited. So if you take that $2,000 and you put it into a deal and that $2,000 earns $2,000 in the same year you made a contribution, that doesn't matter because it's considered an earning. Contributions are new money put into the account, taken out of your personal account or your business account to make an annual contribution, and earnings are based on assets the account holds, and those are unlimited. Okay, so which accounts can I contribute to? Well, you are very likely eligible to contribute to many different types of accounts, and many of these accounts can work together. And so I want to emphasize that you do have to have earned in for most of these accounts. HSAs and ESAs are going to be the exceptions. But for any employer-based plan, a Roth IRA, traditional IRA, you can have those, again, as long as you have enough earned income to contribute to the accounts you would be eligible for. So the IRA contribution limit for traditional and Roth IRAs is based on a total for all of your Roth and traditional IRAs combined. So if you have a Roth with Advanta and a Roth with a brokerage firm and you're under age 50, then you can contribute $7,000 total. So you can decide, well, I'm going to put in $2,000 with my brokerage firm and $5,000 with Advanta. That's fine, but it's total per individual. You must have enough earned income to make your contributions to multiple accounts, and you must be eligible. So if you're eligible for a solo 401k, and let's say you earned $100,000 this year and you wanted to max out your solo 401k, so based on the formula, you could put $48,000, let's say, and then you still wanted to make your Roth IRA contribution of $7,000, you can still do that. You have enough in earned income to do that. So both of those would be qualified contributions, again, as long as you're eligible. You're allowed to have Roth and traditional IRAs with employer-based plans, so we just talked about that. And you will not typically have multiple employer-based plans, but there are some exceptions. So the question that came up, well, I have an employer plan through my W-2 employer, can I also have one for my side hustle or my personal business? And the answer is yes. And again, that might affect how you can contribute. So just make sure you're having your tax professional help you make those calculations before making those contributions. And HSAs and ESAs can also be established alongside an employer plan and a Roth IRA, again, as long as you're eligible. So I'm going to use an example, and we'll get through this quickly. I want to make sure that I'm watching the time for anybody that might have to leave. But this case study is going to partner a few different types of accounts, really just to give you an example of how this could work. So we're going to talk about buying 2024 Main Street, and this is just an example. Jason has 2 children that he would like to establish ESAs for. Because of the contribution restrictions, he would like to partner those ESAs, remember, education savings accounts, with his SEP IRA as well as his HSA. He first finds the property to make an offer, and he works with Advanta IRA to make sure the contract is written properly, shows the percentage of ownership, and because the ownership will be pro rata based on the amount of money each account will participate with, he's going to look to his Advanta account number to help him understand how that vesting will be reflected. Percentage of ownership cannot be changed since the accounts are owned by disqualified persons. You see that note at the end there. And so Jason and his 2 children and his HSA, these are all considered disqualified entities to each other. They can partner, but they can't transact, meaning Jason can't buy back a portion of this asset from his kids' ESAs because that would be considered prohibited. So he's going in knowing that this is going to be pro rata for the life of the investment. So Jason is going to open his SEP IRA, his ESAs, and HSA accounts. He found the investment property and he makes the offer to purchase. He's going to submit all the forms he needs to Advanta, and he's going to read and approve all the documents. So Advanta now has 4 separate accounts for Jason's family. Jason's SEP IRA, 2 ESAs, 1 for each of his children, and then the HSA account. And they are going to help him make the contribution if that's what he's doing, transferring money to a SEP IRA, whatever it might be. So we're going to work with the closing agent to make sure everything's properly titled. We have Jason sign everything as guardian of the kids and of their accounts, and also of his HSA and SEP IRA, so that we know he reviewed all of the documents, but we're actually going to sign everything on behalf of the retirement and savings accounts, and then wire funds for closing. We receive and store the deed and all of the completed closing documents. We deposit the rent, and we pay expenses from all of the accounts. Now, that being said, you're going to see here that with all of these different savings and retirement accounts involved, the vesting is quite a handful here. So each account is represented individually as an owner on everything from contract to deed. So Advanta IRA Services, LLC, FEO, Jason Jones, SEP IRA number 1234 as to 80% undivided interest. And this is based on the fact that his SEP is putting 80% of cash into the investment. And then you can see each of the ESAs listed out here, as well as the HSA. And this looks like a lot, but honestly, getting the vesting is going to be most of the work, because once the accounts are opened, once the investment is done, we're going to do all the separate record keeping for you. And so don't be intimidated by this, 7-line vesting that is going to go on your deed and contract and, anything like that, because when money comes in, we're going to look and say, oh, this is owned by 4 separate accounts. We're going to separate any money that's incoming into the accounts pro rata. And then anytime an expense needs to be paid and Jason lets us know, hey, I need to pay this expense for this investment, we're going to take the money pro rata out of the accounts based on percentage of ownership. So I don't want anybody to be intimidated by this big long paragraph that is the vesting for the investments, because it is truly just a way to show to the IRS that this is separate accounting for several accounts that are making this investment. So although the vesting is long and detailed, Advanta IRA will handle all of the separate record keeping and bill pay for the accounts, and that's really our role. But the accounts can also partner using an LLC or a trust for checkbook control. We had that question earlier. How do you take that long paragraph and make it into something a little more simple? Well, you simply can use an LLC. That same paragraph, point 2 here, this whole paragraph would be the member information of the LLC, or it would be the grantor and the beneficiary of the trust, and therefore giving you checkbook control. If you use an LLC checkbook control, let's say you name it Sun Skies LLC, then instead of all of this on contract and everything to closing and deed, it would be Sunny Skies LLC. And then Jason could be manager of that LLC and he could sign on behalf of all the accounts as manager of that LLC. So, that's a lot of information, I know, but I wanted to give you an example here because some of these accounts with their smaller contribution limits can be intimidating. How will I get this invested? Now, I do a webinar every year, actually a couple times a year, where we talk about investing with limited funds. So it's not impossible to get, $2,000 invested, but it's important to Advanta that your money not come over and just sit without an investment, because it's not earning when it's with us. You have to put it to work. We don't pay interest. We don't have an option for a brokerage account. We want you to bring the investment to us. And so, we're out trying to educate you so that hey, these are options for investments. And then ultimately, we're going to take your direction. So here's my contact information again, and I'm going to take a look. I saw a few more questions pop up, but please feel free to reach out to me, especially with some of those more personal questions that you guys had. I'm happy to go over those with you. There was a question here about what the Advanta's fees are. It does depend. It depends on either the value of the account or the number of investments you're making. You can certainly email me. I'll send you a fee schedule. I'll tell you our annual fee for holding real estate is $345 a year, and that includes us paying expenses and receiving income and doing IRS reporting in most cases. Like, for example, the solo 401k has different options for record keeping, and therefore your fees are going to depend. But you'll have an investment fee and then an annual record keeping fee per asset per account in most cases. Those are the most likely fees. And then feel free to email me and I'll make sure to get you the fee schedule. And I'm going to look, I have a few more detailed questions that popped up. I'm just going to check them out. If I can answer them, then I will do so. We are at the end here, though. Keep in mind the handout is attached to the handouts box. So you can download it, and then you can also, you'll get the recording. It will come to you. And then you can also reach out to me if you had trouble getting the handout, and I'll make sure to email it over to you. I had a question pop up about buying a property in an LLC and using self-directed IRA funds as a down payment. It is possible, but probably not in the way you're thinking. If the IRA makes a down payment, then it is going to be the owner of the property. If you share in the down payment, then you're going to have a share in that investment. And if you're getting a loan to buy the property, then it has to be non-recourse. So if your IRA puts, say, 20,000 down and you put 20,000 down, now you're 50-50 partners in this deal, and you have to use a non-recourse loan in order to acquire that property. And it does expose the IRA to a tax called unrelated business income tax. So I would just invite you to give me a call so we can go over that in more detail. And again, I'm sorry, I'm getting a little hoarse here at the end of this, but I'm happy to answer those questions. And I think it's good to go over that because the investment structure you're talking about is allowed. It's just there's a few steps in there that I want you to be aware of. So please feel free to reach out to me. I don't see any other questions pop up aside from the ones with some personal details. So again, here's my contact information. I'm happy to talk to you. Thank you so much, everybody, for joining us for this presentation. I hope you'll join us for the next one.